Hi there, welcome to the Stockscores Market Minutes for November 21st, 2011. Quick reminder, if you want to subscribe to my free weekly newsletter, you can do so at www.stockscores.com/newsletters.asp. You see the link there on your screen. Let's get right into the analysis. As we always do this in this analysis, I like to look at the charts of different indexes that are driving the market. Right now, of course, the most important thing driving the market is the situation in Europe, and the euro is a good indication of that. The pattern that we see on the euro in the short term is something called a falling wedge. You have the tops in this chart falling quicker than the bottoms, and that is a sign that the sellers are losing their motivation to push the euro lower. So here you see the tops, they're steeper than the slope of the bottoms. What that means is each time the sellers push price down, they don't push it down with the same intensity that they had before. Now, what's important about a wedge pattern is we ultimately need to see a breakout through the top of the wedge. That is the reversal signal. That is a sign that whatever you see the wedge on is likely to move higher. So keep a close eye on this chart, the symbol FXE, because a break of that wedge is an indication that things are, or at least the market perceives that things are getting better in Europe. Until you see the break out of that wedge, do not get too excited, because wedges can continue lower for a long time. Now, obviously, if the euro is in a falling wedge, we're going to probably see the US dollar in a rising wedge, and that's exactly what we see. And again, we want to watch for a breakdown through the bottom of that wedge, because that would be an indication that the US dollar is going to go lower. Now, that's important because it would be helpful for commodities and for stocks priced in US dollars. A falling US dollar makes US stocks cheaper, and it makes them more attractive to foreign investors. Here we have a chart of gold. Gold is sold off for the last few days. What's important is that the high point that was achieved in mid-November is a falling top relative to the previous high. Now remember, if the buyers are strong and they push price up, and then they see some profit taking, and then they try to push price up again, and they cannot hit a new high on the second attempt, that is a sign that the buyers are losing their motivation. And so what we have now is a market in gold that is at a minimum neutral, because we are moving into this sideways trading range, something called a pennant pattern. Now, the market will go pessimistic if we get a breakdown through this upward trend line. That hasn't happened yet. And so right now we simply need to be neutral on gold, but we should be a little bit cautious, because a break of that long-term upward trend line will be an indication that the gold market is likely headed lower. Here's a chart of oil. Oil's had a great run over the last 6 or 7 weeks. It ran into resistance and got stuck. That is what we expect to see happen. My expectation is we will now see oil trend sideways. I don't think we're going to see a considerable sell-off, but more than anything, I don't expect that in the short term we will see a continuation of the strength that we have seen for the last 6 or 7 weeks. That's actually good for stocks, because of course rising oil prices hurt consumer buying power. A pullback in oil is good for investors because it helps the economy. Here's a chart of the S&P 500. You can see that we suffered a breakdown late last week on a breakdown from the pennant pattern that was building there, and that is a sign that the S&P 500 wants to go lower. What's interesting is that today the S&P 500 was very weak in the morning, but it came back to close a little bit closer to the high of the day. Now, when you consider that in light of what we saw on the chart of the euro, that is perhaps a sign that the euro is going to make a little rally here. That could be helpful for stocks for at least a short-term rally. So I wouldn't be surprised if we get a little bounce back in the very short term on the S&P 500, but I can't deny the fact that we have had a breakdown from that pennant pattern, and that makes me pretty cautious on U.S. stocks. Canadian market had a good rally through October, as did the U.S. market, but all that really did was take stock prices up to the long-term downward trend line where they got stuck. What we want to watch for now is whether the market can hold this price that it tried to hold today and continue to threaten that long-term downward trend line. That would create a rising bottom on the TSX, which is a sign that the buyers are starting to take an interest in stocks. Again, I'm pessimistic about Canadian stocks, but there is a little bit of light at the end of the tunnel if we can form that rising bottom and ultimately break through that long-term downward trend line. Now, the topic for this week was looking inside the market, and what I meant by that is sometimes looking at a shorter term time frame than just the one that you normally trade. Now, in this analysis, I typically look at the daily chart pattern, but in this case, what I've done is taken a look inside the dailies at the 5-minute chart, where we can see what's been going on in the market over the last 5 days. Now, this is a 5-minute chart, 5-minute going back 5 days for the S&P 500, and you can see that we are in this downward sloping channel, and we found a little bit of support today. We started to rally up towards the top of that channel where the market will likely find some resistance. And so if you are a little bit more of an active trader, look at the daily chart, but also look at the intraday chart to see how price is performing. Now, if we can break through the top of that channel, we're going to reverse this 5 days of weakness that we've had. What is more likely to happen is we hit the top of that channel and move back down into the channel. So keep an eye on that. Now that we have replaced our charts on Stockscores.com, you can actually look at these intraday charts on many different time intervals. It's quite a nice feature that we've added for the more active trader. All right, so I am, as I said, pessimistic on US and Canadian stocks, neutral on gold and oil. Markets are hitting resistance, and that brings out the sellers. Because of the rising uncertainty about what's happening with the global debt problems, expect volatility to increase in the near term, this making it a market for active traders. We do have a little bit of glimmer and hope, or a glimmer for hope rather, in that the euro could break from that falling wedge pattern, and if that happens, US dollar goes down, stocks should get some bids, and we should see a little bit of a short-term rally in equities. Well, that has been the Stockscores market analysis for November 21st, 2011. Again, if you want to subscribe to my free weekly newsletter, do so at the address on screen. Have a great week in the market and trade well.